Right, the last question we're going to be doing is just one to demonstrate the techniques for earnings per share. I sourced this question from the Untitled 103 from 2015. That's the one you have this semester. Right, as usual, we'll look at the required first, and we are asked to calculate, not disclose, calculate the basic and diluted earnings per share for year ended 31 December 2012. Comparative figures are not required. So already I would expect that you can do the following. In other words, you're able to identify what it means or what needs to be taken into account to calculate both basic and diluted earnings per share. So we will always start off by calculating using the reconciliation of the numerator. And there we're going to have the profit attributable to the parent entity. We're going to adjust for prefs if necessary, preference shares if necessary, and then that will give us our basic number, which we may need to attribute to other classes of equity shares, and then after that we will adjust for all of our potential ordinary shares. There might be convertible debentures, there might be convertible preference shares. I won't write them all down, but that's the sort of thing we're looking for. All right. Then as far as the basic number of shares is concerned, this is just a little calculation where we basically convert, if you like, the total number of shares into the adjusted weighted number of shares in issue throughout the year. And then lastly, we will have the reconciliation of the denominator, and that will involve starting with the basic number of shares, and we will also adjust for potential ordinary shares. So looking at the question then, let's see what it is they've given us. So we've got, starting off with the profit attributable to the parent, 880,000. That's probably worth the mark, so it's better than nothing, that's for sure. 880,000, I'll put that in place. And then we are told over here that the entity has 12% cumulative prefs and 20% convertible prefs. So convertible prefs are a separate class of equity share. For cumulative prefs, that's telling us that 36,000 is going to be our preference dividend, regardless of what they paid. So we're going to have the cumulative prefs, 36,000, and then the participating prefs, they get a participating dividend of 20% of 200,000, that is 40,000. The difference with them though is we're actually going to have a column for the ordinary shareholders' earnings and also for the participating preference shares, which is 40,000. On the 1st of January 2009, so if I just put my little timeline in place over here, I've got 31 December x12. I've got beginning of year 11x12. So this was quite some time ago, 3 years ago to be precise, 1 January 2009. We issued 100,000 10% convertible prefs. So they are a potential ordinary share at 250. The debentures are convertible into ordinary shares, 1 for 10. And on the date the debentures were issued, the prevailing interest rate at a fair interest rate was 12%. Now, to do that, I need a little calculation here, or quite a sophisticated calculation, should I say. And just to show you what's happening, we debit bank and credit debenture liability. But you need to understand, when they are convertible debentures, there's an equity component as well. So what happened was 100,000 times 250, 250,000 was the cash they raised. What is that? That's 2009 2010, 11, 12. That was 3 years ago. All right. So at that date, we had future value that's got to be repaid one day is 250,000. N, when that's got to be repaid, is 2009, 10, 11, 12, 13. So that is 5 years. Okay. I, the interest rate you use is not the nominal rate of 10%. Instead, it is the fair rate of 12%. Your payments, however, would have been calculated based on the nominal rate. So that'll be 250,000 times 10% is 25,000. And you'll use that little calculation to get the fair value of the liability component. 250,000 is my future value, 5 is my N, 12 is my I, 25,000 my payments, and what we're going to, those strictly speaking are negative because we're going to pay them back, which means that the fair value of the loan that we got is 231,976. 231,976, which means that the equity component in these debentures is 18,024. Then, lucky for us, there were no transaction costs, and we are now looking at, if years 1, 2, 3 are gone, we're looking at year 4. All right, and what concerns me there in year 4 is, so for period 4 on its own, amort, the interest is equal to 28,986, and that I need to use because the convertible debentures, all right, there is an interest amount, so that's 28,986, and let's refer them to working 1. We'll call what we did there working 1. All right, and the tax effect on that at 28% is 8,116. So although we'll save interest in years to come, we'll end up paying more tax on that interest. Okay, so that's that one done. In addition to that, these debentures can become ordinary shares. So one debenture into one share for 10 debentures. So that is 100,000 divided by 10. So in my reconciliation of the denominator, convertible debentures, I want to say over here that these 100,000 debentures can, or 10 of them can become a share. So they have the potential to convert into 10,000 ordinary shares. That's that one done. In addition, on the 1st of January 2011, they issued 20,000 convertible preference shares. Oh my goodness, I read that wrong just now. Those aren't participating preference shares. So I didn't need this after all. Okay. Convertible preference shares to the value of 200,000, and they're convertible in a ratio of 3 ords for every 1 pref. All right, so in that particular case, the convertible debentures, we will save 40,000 if we don't have to pay the convertible preference dividend. Apologize for that little mistake. And they will convert into, there are 20,000 prefs and 3 of them convert into 1 share. Let's just make sure. The convertible are convertible into ordinary shares in the ratio of 3 ordinary shares for 1 pref. Goodness me, I'm not being very clever, am I? So these 20,000 will become times 3 is 60,000 ordinary shares. All right. These you would always prorate for a year. So if these items were issued during the current year, which they're not, you would prorate them for 6 or 8 or 9 over 12, as the case may be. Not the case here, though, so let's not stress about that. Right, that's that one done. Then as part of his performance measure, they entered into an agreement whereby they would issue at no cost shares to their senior staff if the market price exceeded 5 Rand. All right. At the reporting date, the market price does exceed 5 Rand. That means these are treated as potential ordinary shares, which means that we will have to include here, we call these contingently issuable shares, 75,000 shares. And they were issued during the year, in April. So May, June, July, August, September, October, November, December. That's 8 over 12. And like I said, if they're issued during the year, you weight average or you prorate. So 75,000 times 8 over 12 is 50,000. Those are the contingently issuable shares. Just for your information, if this number over here had been less than 5 Rand, okay, then you just simply leave out those potential ordinary shares completely. No dividends were paid or declared by any of the companies during the year. So that means neither ordinary nor preference. Okay, so then I might just change this because just the little rules, and I just want to recap with you those rules. If, for example, we've got cumulative prefs, it doesn't matter whether they're in arrears or not, you always take into account that dividend. In the case of non-cumulative, now it doesn't say there, so I'm going to assume those are non-cumulative. And just to make this point, all right, that means this number here would come out, and that number there obviously would come out as well. So I'm not going to put those in, and I'm not going to put that in either. So what we've got now is our basic number. So your basic earnings is this one over here, net profit after prefs. So that's going to be 844,000. All right. And then your diluted earnings is after adjusting for the earnings adjustment on these potential ordinary shares. So 844. And then we're going to add back the interest of 28,986. But then the interest saving minus 8,116 gives us 864, 870. That's what we call diluted earnings. And then we've got our adjustment over there, adjustments. And the last thing I'm going to need to calculate is my adjusted weighted number of shares. It seems as though they've given us that. Oh, how cool. Okay, so that's 468,750. So I'll slot that in here. That's 468,750. Gives 588,750. So what they wanted from us, so here's my pretty answer. They wanted basic earnings per share, which is going to be my basic earnings, which per my numerator is 844,000 divided by my basic denominator, which is the 468,750, and that's going to give me, well, what's that in cents per share? 844 divided by 468,750 is equal to R1.80, rounded off, it is R1.80. Okay, my diluted earnings per share, and if you're stressed for time, let me show you what I would do here. It's 864,870 divided by 588,750. So your diluted earnings per share is equal to the diluted earnings divided by the diluted number of shares. Now, what our standard tells us to do in this instance, where you have more than one type of potential ordinary share, they tell us to calculate that option that has the most dilutionary effect on earnings per share. So, and to do that, here's your little working. So the first thing I'm going to do is I'm going to have a look and see that what I did with my earnings per share. So with my adjustments, my diluted earnings per share. So that adjustment there was 28,986 minus 8,116 is 2870. And if I divide that by the number of debentures, all right, divided by 10,000, I get a 20,87 adjustment. For the convertible debentures, obviously I get an adjustment of 0. 0 divided by 60,000. And for the contingently issuable shares, they also don't affect my earnings. I've got 0, okay, in the earnings number. So what we do then is we rank these from smallest to biggest. So that's a 1, that's a tie 1, and that's a 2. And then what you do is you do the following calculation, which checks to see what the most dilutive combination is going to be. So if I start, this is a working again, with my basic earnings of 844 and my basic number of shares of 468750, I get 1,80. Okay, so that's my earnings number, that's my shares number, that's my EPS number. Then if I take the two that rank number 1, I've got the convertible debentures and the contingently issuables, my earnings doesn't go up, but the number of shares goes up by 60 and 50, which, if we calculate this now, I've got 844. This is going to be 578,750. What does that give me? 844,000 divided by 578,750 is 145 per share. So what you can see is that has got smaller, which is called dilutive. It's a dilutive adjustment, all right? Which means that those two together, they're both dilutionary, all right? Now what we're going to check is the one that ranks number 2 is the convertible debentures, okay? And there was an interest saving of 2870. The number of shares they would convert into is only 10,000, is 10,000. And if I check my calculation now, I've got 864,870 divided by 588,750, and that gives me 864,870 divided by 588,750 is 1,47. Now you will see that movement from there to there is what we call anti-dilutive. It's getting bigger, which means that what we should do is we should cross out the convertible debentures. Okay, they should not form part of your diluted earnings per share combination. You can see what I did there though is I put everything in my answer because you are going to have to do all these calculations anyway. All right. So if I did run out of time, at least I've got everything in my answer. All right. And then what I do is I do this dilutive, anti-dilutive calculation to see what is the most dilutive combination of those potential ordinary shares. And what you see that if you take into account the contingently issuables and the convertible prefs, you get a more dilutionary effect than if you add to that combination the debentures. All right, so we're going to leave out the debentures because the other two give me a more dilutionary combination. And that then is, we'll disclose over there, is equal to 1,47 being the 844 divided by 578. So this was 844 divided by 578,750. That was the calculation that I needed. All right, so that concludes that question, and then we'll have a look at how these things get marked in exams, and then we'll be done.